instead of moving on, like, oh, okay, 200,000, I can't do anything. Remember, I want you to teach you that there's a concept with North American, we call it our smart money, where we can actually take that money and put it into a life insurance product that I said is very unique to the market, and provide a couple different things. And we're going to go over those with you today on, try not to stop at that conversation and dig a little bit deeper on that money, that 100, 200,000, and look at North American for that. So here's our agenda for today, guys. We're going to define smart money. You know, what the heck am I talking about when I'm saying smart money? What do we mean by it? What is the client's objectives with regard to their smart money? I'll look at one product. All we're talking about today, guys, and it's not even really a product push. We're talking about a concept, and it lies hand in hand with the product. We're talking about the life insurance solution. How can that be a solution of the client's needs? And then also tips and talking points. Everybody likes seeing the illustration, so I'm going to show you a couple of illustrations today and show you really how to kind of hit a home run with the sale, if you will. So what do we mean by smart money defined? Accessible assets, guys. That is funds that the clients really want to retain as both accessible and with limited exposure to loss of value or principal. I'm going to talk about accessible. You're going to hear that a lot today, okay? And I'll show you how that's possible. Those are funds the clients want to have control over in the event they may need it, okay? So here are some examples of it. And I talked about, you know, the money market accounts. We got annuities, old annuities that are underperforming. I'm thinking annuities right now, a lot of them I'm seeing annual caps 4, 5, 6%. You look at IULs, we're in the double digits on a lot of our caps right now. Savings accounts, here in North Dakota, we're getting, Fargo, for example, we're getting probably under 1% on my money market account, and have been for quite some time. We got to keep in mind, too, a lot of those, you know, there may be some penalties, charges, and accessing them early, but they're all generally accessible with loss potential of a known limit. And these are all assets, guys, that are going to be immediately recognizable for the life insurance sales concept. This one really resonates with me. In the state I'm in, out west, we've got an oil boom here in North Dakota. Obviously, oil prices are a little bit lower now, and the boom's kind of slowed down. But 4 or 5 years ago, there were people becoming millionaires overnight. Windfall inheritance, look for those. These people have no idea what to do, and I'm talking millions, guys, out west. These people are they're becoming millionaires overnight with oil leasing. So think about where you're at. Do you know some people that inherited some money, recent windfall? What is your local economy in your market? Those are some ideas as well for the smart money. So we also ask the question, and we have to ask the question, is what do the clients typically want their smart money to do? Okay, again, we preface it with this money is not needed really for current income, okay? They're not taking income off it. It's maybe disposable income, right? It's ultimately going to go to the benefit of the client's heirs, okay? So the first objective is we need to maximize the benefit for the heirs, and that's life insurance, right? You know, putting in 100,000, turning it into 300,000 tax-free on that, 200,000 above the cost basis. We'll talk about that in some illustrations too. We also want to help maximize the benefit for the heirs, like I mentioned, and the clients also want financial protection, right? This is their smart money. They might need this on a rainy day. They might need this if they have health issues, okay? So we want to keep giving them access to it, and that's where this is really unique, right? We normally put money into a life insurance and there's surrender charges, right? That's where this is going to be really unique. And we also want to leverage it into a larger estate for the later years. So how do we give them that access to the funds? We'll talk about that. That's really the sizzle in this, guys. So since this is smart money, the second objective was to retain access to the funds. You know, whether it could be for an emergency, unexpected need, could even be for some future need. It may not even occur. We don't know, but it has not yet been identified. So we want to give them that option that, you know, if it does happen, we want to give you the option to get to your money. The third one's a competitive return. Those could be identified, again, return of eventual benefit for the heirs, performance potential. Keep in mind those competitive returns, those need to be measured in context of other smart money vehicles, as we previously mentioned. So we always want to upgrade the client. We want to get them into a better product, right? And that's the purpose of policy reviews. We go in there and they've got something that's better than what you're pitching. Hey, great, stay with it. This is unique, though. So we go to the second part of the agenda. How, you know, Troy, you talked about smart money, where it's coming from. How the heck can life insurance? Here's our solution, guys. The Rapid Builder IUL. The main aspect, remember, is the death benefit, right? We're all talking life insurance. Another option for the client's smart money could be a product like this Rapid Builder. It's a non-guaranteed indexed UL, okay? This generates a death benefit protection for the family, remember, during the working years. So they might still be 45, 50, 55, whatever the case may be. They haven't hit retirement yet, so they still need that death benefit need, okay? Not saying you can't write this product on a 65, 70-year-old where they've already retired, but that's still part of our sweet spot on this. They also want the estate building benefit for the clients and the heirs in the retirement years, and that's where the IUL comes into play. Another objective was the access to the cash. Well, how the heck do we give them access to the cash? Twofold, guys. The Rapid Builder has no premium load. Okay, I'll repeat that, no premium load. Most life insurance products, in fact, all of our other ones besides our second to die or survivorship product, have a premium load, okay? They don't have the waiver surrender charge rider. That's where this product comes into play. You combine that no premium load with that optional waiver surrender charge rider. So that's what it does. It waives surrender charge rider. This product has excellent access to early cash surrender value. And that's why we named it the Rapid Builder, right? Builds up cash rapidly. Additionally, you're going to learn some things new that we don't normally do every day on the illustration, right? This one we run the CVAT, Cash Value Accumulation Test. Typically, 9 out of 10 cases that you guys probably we run at the home office are guideline premium test. This is a little bit different. We'll run the CVAT test. We do that because the death benefit, that's going to allow it to be kept basically relative low to the premium going in, okay? Something we're not going to be able to do on guideline premium tests, and I'll go over that in detail here in the next couple slides. You combine all of that, guys, that's going to help provide as much cash value access in those early years as possible. We can't forget too, guys, this is the big part here too, is accelerated death benefits. Chronic, critical, terminal, those are basically what we call living benefits. The old adage in life insurance, we've been calling it a death benefit for how many years, right? Typically, the only way you can get that death benefit, you die. It's life insurance. You die, the beneficiary gets that money. Well, not anymore. On this new life insurance, that client can actually access those death benefits through living benefits, right? So they can accelerate some of their death benefit if they become chronically ill, right? Long-term care, that's what a lot of people call that. Critical, the cancer, the strokes, the heart attacks, and then also terminal. Terminal's been around for many years. You know, if they become given 24 months or under to live, they could access up to 75% of their death benefit. Remember, guys, that's typically a tax-free transfer, and we'll talk about that here as well. With North American, there's no additional upfront cost or underwriting for the accelerated death benefits. They're automatically included on there. So that does two things. Number one, it's not pulling money out each month to pay for the cost of insurance of something that you might never use, right? It's a reason why a lot of Americans don't have long-term care. It's expensive, and it's something they might never use. So they don't want to buy it. Same thing with our accelerated death benefits. It's built in. There's no extra cost up front for it, okay? We talk about long-term performance. With North American, we're a privately held company. We're not publicly traded, so we price our products for the long term. You know, we're not quarterly. We're not keeping shareholders happy every quarter. We're kind of more of a long-term focus. When you look at that, one of the things we can put on there is a guaranteed interest rate bonus. It's 75 beeps, so 7.75% of a percent. On this product, it's available in year 16, so they're guaranteed 0.75% on top of what they return. Folks, that's conditionally guaranteed, okay? So that can't go away. That's guaranteed into our product. By the way, our other products, Rapid or the Builder, Guaranteed Builder, that interest rate bonus is available in year 11. Just the different way they're basically priced. So this Rapid Builder we'll show is going to demonstrate the potential for that competitive return, and then looking at the death benefit and or the cash surrender value. And we've got some cool reports that we can run that I'll actually show you. It's called our internal rate of return report. I'll show you that here in the coming slides. So here's basically the nuts and bolts of the illustration. For those of you that have been with Tom, you're right in business with us. Number one, we appreciate the business. So you're probably pretty familiar with this. For those of you not, thank you for joining the call today, and hopefully you can look at North American and this product and really see the benefit of it. So let's take a look at this example. Basically what I did here, guys, is I got a 55-year-old male, standard non-tobacco, and you can see here the waiver of surrender charge. I've got that rider chosen in our software. Whether you use WinFlex or NASA's, our standalone software, you have to choose that rider. So this product can be designed without the rider or with it. This one I put it on just to go over the true smart money concept. We look at this is the Rapid Builder IUL, same product we talked about before. And again, we're using the cash value accumulation test, CVAT, okay? So we're not using guideline premium test on this. This one here, I specify the death benefit at $508,000. So here's what we're doing. We're doing a large single pay, right? $200,000. We're not paying any more money into this. So this money, let's say, is coming from a money market account in the bank, right? It's getting 0.8%. 200,000 going in, large single pay. And the client, after doing our needs analysis, if you will, we found out that he needs about $500,000 in coverage. You know, I've still got a mortgage. I'm still young. I'm 55, 30-year mortgage. I still owe, you know, $500,000 on my mortgage. Whatever it may be, we defined and found his need a death benefit of $508,000. That basically met his needs of leveraging that premium into a larger amount for beneficiaries. I'm probably not teaching anything new, but we're putting in 200 grand. He dies tomorrow, guys. $508,000 is going to the beneficiary tax-free. That's a beautiful thing. Plus, this 508's available for accelerations on chronic critical terminal. Okay, there, right there is a sales idea. So the first thing we want to look at is that death benefit. We can see here, again, it's just a little over 500,000. On the far right column, we see that it's projected to grow, right? You can see here year after year it's projected to grow. That's because the policy is heavily funded and the cash value accumulation test is requiring the death benefit to be increased. And that's to accommodate the funding level, right? We still got to qualify this as life insurance. That's what we call corridoring in the life insurance field. Again, since this is their smart money, he also had concerns about, hey, I need access to it. I want to know that if I need access to this 200,000, just like my money market account, I can go and I can get it. Okay, that's the big thing. So since that's the smart money, we put the waiver on there. This illustration is reflecting 3 columns. As a lot of you know, we're in AG 49, right? There was 2 phases last year, and then this year, March 1st. Part of AG 49 was requiring all companies to do 3 columns. So a lot of you that have been maybe using other companies in the past, you're probably wondering, those companies did 2 columns for years. In March now they have 3 columns. That's why, AG 49. We always did 3 columns. What do these mean? What the heck do they mean? The far left, guys, is kind of the worst case scenario. If you're out selling annuities, this is really where the concept resonates. We got a lot of annuity advisors wanting to learn the smart money, wanting to sell it. And let's be honest too, we don't know what the DOL is going to do. So we have a lot of, like Tom's group, we have a lot of people on this call today. And a lot of you are probably saying, I don't know what the DOL is going to do. I sell annuities. I've been told I need to learn IULs, whatever the case may be. You're probably I know you're in the right spot. So we look at this far left column, guys, is our guaranteed interest rate of 3%. Okay, that's the minimum on the product. So this is basically saying we're going to guarantee a 3%, but we're also going to increase our cost of insurance to the maximum every year. Year in, year out, every year we're going to increase our cost of insurance to the maximum. Guys and gals on the call, we can go back 38 years right now. I've been told by actuaries, we've never found one instance where we've ever raised cost of insurance, let alone to the maximum. We haven't raised it $1. This is saying we're going to raise it to the maximum. So I wouldn't concentrate on this far left column. These 2 is what I'd really focus on. This is basically our minimum guarantee of 3%, and I dialed it down from 4. It defaults to 4, but I put it at 3% because I want to be very conservative. So this is basically saying, hey, worst case scenario plus current cost of insurance. This is what North American's been doing for 60 plus years. Feel we're obligated. Integrity is one of our core values. We don't want to raise cost of insurance on the in-force block of business. That's why we price products for the long term, right? So this is basically saying, hey, if the product doesn't return, market doesn't return what we want it to, this is what you're going to be getting. So you look at after year 1, he's got return of premium plus some. That's the beauty of this product. So what is this far right? This one I even dialed down. Our AG 49 look back is 6.89. I won't go into where we derived this number, but this is our hypothetical, guys, kind of looking back. So I went 6 3/4, and this is where you can see that death benefit hitting corridor each year. So those are the 3 columns. You know, the big part is too is the accessibility to the funds, right? We need to overcome surrender charges. Look at here, you can see it at work, 202,000. So there's no surrender charges with the waiver of surrender charge. It matches the account value, okay? So next question is, what about limited exposure to loss, okay? And then we also combine that with potential for cash value. You can see here, even under the worst case scenario, almost 95% of the client's premiums paid would be accessible as surrender value for here at least 10 years. So the center non-guaranteed alternate, that one here is at 3%. That again, guys, indicates that unless COIs are changed, regardless of interest rate performance, the surrender value would exceed the premium paid in this example for a number of years. And then the third one, that's again our hypothetical. Couple things to look at on this. As a reminder, this is cash value accumulation test, CVAT. Okay, remember that allows the policy to be funded at levels that it's not going to be possible in the guideline premium test. If I did, you know, minimum death benefit using guideline premium test, I think we'd be right around 1.5, 1.6 million on this. Well, the client already told us, I don't need that much death benefit. I only need about $500,000. So that's the beauty of this concept, is we can play with that death benefit. And I'll show you in the next slide, we'll even lower that death benefit and show you what that does. So we have a very low initial face amount given the premium paid. So of course we need to make sure that death benefit's large enough to meet their needs. This one, he said it did. Another thing I want to talk about is, you're probably already asking, well, how is this not a MEC? It is a modified endowment contract, okay? So this is a single premium. There's no way around it on a CVAT. So gains in this policy could be taxable if surrendered or distributions are taken additionally prior to 59.5, may have that tax penalty. Let's go back a little bit though. Remember where this came from, right? The money market account. Remember, this is not all that different than the tax treatment of an annuity, a money market account, a CD, okay? So that we're not doing anything different where they came from. We got to remember, though, too, the death benefit, that retains its tax advantage on a MEC. That's a question we get periodically here at the home office is, hey, I've got a modified endowment contract. Is the death benefit still tax-free? Yes, it is. So keep that in mind. This 508 is tax-free. We also indicate on this one that the chronic illness, that one's present. So again, if the client becomes permanently unable to perform 2 out of the 6 ADLs, which are activities of daily living, they can accelerate a large portion of that death benefit, guys, tax-free. They can access that. So that's another idea too. I always say, you know, when you're doing policy review and you ask the client, do you have life insurance? And they'll say, yes. The next question you should ask is, do you have the new life insurance or the old life insurance? Guaranteed you're going to go, what does that mean, new life insurance? Well, I see your old life insurance is an old whole life policy, or it's an old UL from 10 years ago. The new life insurance now allows you to access that death benefit while you're living. Your old one I see doesn't have that. Okay, kind of a little sales idea. New life insurance, old life insurance. So hopefully you're asking, you know, if you're nerdy like some of us here, is how about the competitive performance? How, you know, what is the IRR in this? This is our internal rate of return report for that same illustration I just showed you guys. This is an optional report. You can run it on WinFlex. You can run it on NASA's, our standalone software. You're probably not going to run this on everyone, but I always joke, if you have that engineer client that he or she wants to see everything, wants to see cost of insurance, we have all that available. And this is a pretty powerful sheet here. The columns I want to take note on is the death benefit IRR, and then also the surrender value IRR. So in the short term, clients obviously most concerned about the IRR of the death benefit, right? What if death occurs in the near future? Well, as we get further along in the policy, typically the client should be looking at to see if the cash value IRR is competitive and meets his needs. This one here, we're actually showing a really competitive one in the first 30 years, ranging from 4.86 to 5.71. Ultimately, you know, we're all mortal, unfortunately. That's where the death benefit column is going to come into play. As you can see here, the death benefit's larger than the surrender value, so it obviously demonstrates a larger IRR. So remember, of course, the death benefit's generally income tax free, so that number has even more value compared to a taxable return. Okay, so here's another variation. For clients who are even more concerned about access to cash surrender value, remember the death benefit could be manually reduced to a smaller amount. Okay, so technically, how small can we go? That's a question we get a lot. How small can I get that death benefit? If we wanted to, we could put the death benefit to the dollar going in. Okay, so I can't go $199,999 because I'm putting in 200, but I can go 200, 200. Okay, I can go 500, 500. So you can put the death benefit as low as the premium going in. This one I manually dropped down to 300. Okay, so we're 208,000 less than before, right? We're at 508, now we're at 300. The beauty of this, it's really cool. So although the CVAT test, cash value accumulation test, that caused the death benefit amount to increase immediately at issue, right away at issue, we're at corridor. If the guaranteed performance columns presented themselves as reality, the death benefit would be allowed to decrease, as you can see here. Okay, so that reduction in death benefit in the poor performing years, that can result in a lower cost of insurance charge than a level one of 500 or more. Remember, the higher the death benefit, the higher cost of insurance. I think we all get that. So in this one, the cash surrender value, that's even more compelling, right? I think we were at 202 on that other one. We're about $1,000 more after that first year. So that reduction in death benefit in those poor performing years, again, lower COIs than that $500,000 we had before. So again, the cash is going to be even more compelling. In this one, the surrender value, if you look, remains above 200,000 for 27 years. I only ran this 20 or 10 years just for simplicity, but if we had the full illustration, you can see. So you might want to dial down that death benefit to meet the client's desired surrender value in the guarantee columns. Now, remember, agents, we're all agents on the phone. You know, we've got to provide for our family as well. Remember that lower death benefit also impacts the target premium, okay? So the target premium in this case is, you can see here, $4,086. For those of you that caught that previous one, the other one was $6,918, so almost $7,000. So we dropped $3,000 to you, to your pocket, by lowering that death benefit, okay? So just an FYI, you know, the higher the death benefit, the more you're going to get paid. And honestly, guys, if we had that other one at 508 compared to 300, we were only talking $1,000 difference in this middle column. So keep in mind, that's the beauty of this, is you can play around with that death benefit. So did the rapid builder meet the client objectives? We look at that, left the benefit for the heirs. Yeah, that's actually the purpose of life insurance. I felt this product did it really well. Accessibility to the funds, unlike any product out in the market, guys. Yes, we demonstrated significant cash surrender value, as well as the benefits like the chronic, critical, terminal, and then competitive returns. We showed that internal rate of return report. That's why I wanted to show you. That gave us a great example of the potential returns. Tips and talking points. Here's some things, again, to consider that we don't want to forget about. MEC status, okay? Since this is often funded as a single premium, it's likely that it would be a modified endowment contract. I'm going to let you know, too, our typical case size on this is well over 100,000. We're not looking for the bank accounts, guys, that are 5, 10,000, okay? We're not looking for somebody that has 3,000 in a checking account. Yeah, I can use that and do the rapid builder MEC status. This is more for your, 50 years old to 80 with large amounts of money sitting in some vehicle that we already talked about that they're not using for income. So as a modified endowment contract, make sure everybody's aware of the tax impact of this. Obviously, we're not moving qualified money in this, so this is really no different than where it's coming from. But typically that MEC status, that's going to concern us agents, guys, more than clients. Typically as agents, we're more scared of the MEC than the client because they probably don't understand it until we teach them. So we know that a MEC's a disadvantage in some situations, like our builder. If we're doing a minimum death benefit, max loans out at 65, they're 30. Yeah, that one we don't want to become a MEC, right? We're taking tax-free loans. This one, the whole sales concept is turning this one into a MEC. So that allowed us, by doing that, is to illustrate much better access to the funds, and they were not eaten up by excessive charges. So again, if we did guideline premium tests, guys, this would be $1.5 million. It wouldn't work. So we need to keep that in mind. I love this one. This is the second one, systematic premium allocation. Right now, this is the only product that we have this on. We redesigned this product about a year ago, and I'll tell you what we did when we redesigned it here in a little bit, but this is one thing we put on there is systematic premium allocation. So as we saw with the single premiums on the smart money sale, that means one index segment maturity date per year, right? Typically, they put in the 200,000, they do annual point to point, let's say. You got 2 points. You got a starting and you got an ending point, right? On a lot of money, 200,000. Well, clients are getting smarter, and we know that. Some clients prefer spreading out that allocation. So this feature allows the client to put the funds into a fixed account, it's paying for right now, and then automatically transfer the funds to an index account and spread out index segment dates over the year. It's basically dollar cost averaging is what it is. We'll do that for you. They don't have to, but if they want to, you fill out that form. It's a supplemental form on the application, and we'll do the rest. Again, CVAT. We talked about that. Don't use guideline premium test on this. CVATs are going to allow us to do things that aren't available. And the beauty of this product, guys, the waiver of surrender charge rider. This is probably new to a lot of you guys. Like, that is a cool rider, and we're the only ones that have it besides really Midland. What does that do? Provides a very attractive early access to cash by eliminating surrender charge. That waiver of surrender charge, guys, also includes a table shave feature. So the client can actually get up. Let's say we rate them table 2 or table 3. So if they're rated up to table 3, they'll receive standard rates. So the previous illustrations I showed you, if they go through underwriting and the underwriter comes back and like, hey, they're table 3, with the waiver surrender charge rider, we'll dial it down to standard, okay? So that's going to be really helpful for the clients who they're not perfectly healthy. So that's something to keep in mind as well. So here's a really important screen, guys, and kind of want to pay attention to. Tips and talking points. You have 4 options to get paid commission on this product. That's neat too, right? Typical life insurance, you have one option, more heaped up front, and you get some lower access renewals on the back end. This product, when we redesigned it, we're really going after a lot of the RAs out there, the registered investment advisors, the fee-based planners. Gals and guys are out there that are actually selling like that are more used to renewals, okay? Less upfront, more renewals. So let's take a look at these a little bit different. Option A is an Apple. That's more of a traditional. That's the one we're all used to. You're going to get the heaped without the basically the asset trail. Option B is in boy. That has an asset trail, but it still has some heat commission, okay? But it's also, it has a significant asset trail for years 2 through 15, and then it's followed by a smaller trail for the remaining policy years. And then option C is in cat. That's a percentage of premium. If you're an annuity producer, you're going to probably feel more comfortable with option C. That's typically kind of comparable to what you guys are getting paid on annuities out there that are selling them. My favorite one is option D. That's really, I think, again, this is all the product. Option D is in dog. That's asset-based. So after an initial small percent of premium paid the first year, commissions are paid on a significant asset trail in years 2 through 15, followed by a smaller one in 16 plus. The asset trail in option D, as in dog, is larger than option B, but it's without the heap. So you kind of want to ask yourself is, you know, what do I want? If you're talking a 50-year-old and you really truly think, you're putting in 200 grand, let's say, on this, and you really truly think, you know what, this client, she's not going to touch this money. I know the family. I've been their financial advisor for so many years. You know what? I'd go option D. Okay, because as that policy, your asset base, by the way, is off accumulation value. So as that product's, let's say, capping out a couple of years, it's returning 6-7%, let's say, whatever it may be, that's what your money's based off of, is that compounding interest. So their account value is what your commission's based. It's not based off that initial 200,000 that we put in. It's based off of as that product increases. So let's not forget that. Now, this might be, you might be like, holy cow, which one do I choose? Well, fear not. There's a supplemental report available in our software that's going to be able to calculate the potential total commissions over a 20-year period for you, showing you all the options that are available. Okay, so Tom and his team can provide that for you. If you're familiar with the software, jump in there and go to the reports tab and you can show that. You are going to need to choose a commission option at time of application and submit that with the application to new business. Okay, that's done through a supplemental page, and that'll print out at the end of the illustration. Okay, so fear not, it'll be on there. You just got to find it. It's the last page. Only the available commission options will be displayed on the form. Okay, so if only option A is available, it's going to have X'd out B through D. It's going to make it easy for you. If the premium's over $250,000, first of all, nice sale, congratulations. We will require, when the waiver surrender charge is elected now, we will require either option B or D. Or if the face amount is below that first year corridor, then only option A will be available. Remember the corridor on the illustration, the tabular detail? That was we put in 300,000. I'm going to go back here just to show you what corridor is, because there's some confusion sometimes on that. This is the corridor, guys. So if we do we've got 200 going in, if we specify the death benefit 300,000 in the waiver selected, and we're below that corridor, which we are, right? We're not above 485, 651. You're only going to have option A available. So just kind of an FYI. Again, here's one thing too, guys. When the waiver surrender charge is elected for these sales, you need to be aware that the commission chargebacks will apply. Okay, so I mean that's the whole. You probably already got that without me saying that. Is how do we recoup if the client does surrender? So before we go over chargebacks, though, I want to let you know of something really important. The client, like an annuity, guys, they can take withdrawals up to 10% without you guys incurring a chargeback, and that's of the cumulative premiums paid per year. So what does that mean? What do I mean by cumulative? Well, let's say the client doesn't take anything years 1 and 2, and they call you and say, hey, I want to take some withdrawals off this policy. Technically, they could take up to 30% in year 3 because they didn't take their 10% in years 1 and 2. So they could take 30% in year 3 without you incurring a chargeback. Let's say they take 35%. You're only getting a chargeback on 5%, right? Because 30% is free. So just an FYI, it's still pretty liquid without you guys getting banged on it. And you can see here too, when the waiver is selected, the commission chargebacks are A and B are the same. They're a 3-year, 175.25, and then option C is a little bit longer, but it really dies down as years go on. And then option D, again, that's my favorite. You're out at year 3, guys. It's 100 year 1, year 2, it's 50. So just an FYI. Again, tips and talking points. Ask yourself how you want to show that middle non-guaranteed alternate. Remember, it defaults typically at 4. I dial it down to 3% because I want to show kind of worst case scenario. And I want to tell you guys too what the heck those 3% means. That you don't have to have your money in the fixed account with North American to get 3%. How would you like in this low interest rate environment? And like I said before, Guggenheim said 10 years we're going to be in this, unfortunately. I hope they're not right, but they're usually pretty spot on with a lot of their stuff. How would you like to go to your client and say, listen, you're in the money market at 0.8%, wherever you be, how would you like a product where I'm going to guarantee you 3% minimum return per year, regardless of where your money's allocated, but I'm also going to give the opportunity to return 12%. That's our current annual cap. 3% guarantee with a potential of 3% or potential of 12% and an annual reset ratchet design. That's pretty powerful. We're the only company out there really that I know of that has a guaranteed interest rate. We call that our true up. Okay, so you're guaranteed to get 3% regardless of what the market performance is. So just keep in mind on how you want to illustrate that. General concept pages, we have all these available on our website. Tom and his team have a marketing website available to them. If you guys are really into this smart money, talk to Tom and his team, and they can get you the whole sales concepts with it. So as a summary, I'm going to put this up on the screen. What did we do today? We defined smart money, kind of told you how we're going to do it with our products, helping meet the client's needs. We discussed the life insurance solution. There's only one product, guys. Keep it simple. The Rapid Builder is the only one that's going to work for this, only one we need. So we position that product. And then the tips and talking points. Couple things we're doing different, right? We're using CVAT, it's meching. That's all good in this illustration. So the bottom line, and I'll close with this screen, is the client gets death benefit protection. Okay, that's the main thing, guys. We can't forget this is life insurance, death benefit protection, accessibility to that cash value, unlike any other product in the market, outstanding growth potential, double-digit caps. You guys as an agent, you get a smart money alternate. So that conversation you have, what are you doing with that 100,000? I've got a concept for you at North American where I can help show you what that 100,000 can do for you, 200,000, whatever it may be. And then the support with Tom and his group, the resources to help grow business through INA and also North American Life. So with that said, that concludes my presentation. And I'll basically hand it back to Tom for any closing remarks or any questions that have come through during the presentation.
Appreciate that, Troy. And everyone, I just want to say Troy and North American have been terrific partners to us. And I, from time to time, give Troy a hard time because I don't think you can hear more passion in a presentation than I think what you just heard. It's clear, Troy, you love what you do. I want to say that North American, in addition to the Rapid Builder that we talked about today, they have many other great solutions. So I really encourage you to take a look at everything they have available there. As far as if you have clients in mind that you think this would be a great solution for, please don't wait. Give us a call. We will help you put a proposal together. We have the case managers that can take all that busy work out of ordering the parameds, all that other stuff. That's what we're here for. Our number is 800-456-7999. I know many of you have that already. But our sales team will be following up with you. But again, if you have someone in mind you want to talk about, don't wait. Give us a call. Again, with the month of September being Life Insurance Awareness Month, our purpose was to provide you with some additional ideas, sales tools, another view at the Rapid Builder, what you can do with clients that have that lazy money, maybe sitting on the sidelines, not earning much. This is a great way to utilize this. So I want to thank Troy for taking the time to be with us today. I want to thank all of you for taking the time out of your busy schedules to jump on this call and let us know how things went, what we can do to help, and again, have a great rest of the day. Thanks.